All right. Thank you so much, Alex, and good afternoon, ladies and gentlemen. Welcome again to today's webinar hosted by us and Darling Commodity Exchange. My name is Chen, and I'm great honor to make an appearance as well. As you may know, today is the second webinar of our series of webinars on domestic and foreign future markets that we hosted. Well, from the last webinar, we have two outstanding analysts introduce the detailed rules and comparison of DCE iron ore futures and SGX iron ore futures. And today we turn around to Cayman Islands and discuss some investment models derived from it. Speaking of Cayman Islands, usually the first thing that comes to our mind is what tax and flexible supervision and low registration costs, right? And that is basically why many international companies and financial companies, such as Apple and Google, choose Cayman to register overseas entities. Well, in addition to that, Cayman's legal and financial institutions are very sound. World-class law firms, banks have all set up special offices and branches in Cayman, as well as many business groups, of course. Like we always said, there will be a market if there is a demand. Because I noticed that the other day, the 25 largest banks in the world have established subsidiaries or branches on this small island, which made Cayman's financial and trust assets has already exceeded 250 billion US dollar by the end of 2020. Okay, so that was some basic intro I want to share with you guys. Just trying to give everybody a general idea what we're going to talk about today. Since Peter and Jimmy has already gone through the method to access Chinese market, I will start my part with the big picture of Chinese capital markets as an entry point. And from there, I will introduce how could overseas investors participate, as well as what kind of services Nanhua Futures can provide to our clients. Then we will call it a day, okay? So first, I would like to show you some numbers. China has been putting so much effort opening its capital market to the world since year of 2001, when China joined the WTO, right? Market reforms in China has been taking place for many years as the government looks to internationalize the RMB and, opening domestic financial markets to attract foreign investment. And I want to say this, I have all the reasons to say that the Chinese government further accelerated the pace of these reforms in 2020 to open up capital markets to foreign investors, either in market access and expanding the investment scope. Among those capital market reforms, the most impressive one was the deregulation of QFII and RQFII policy, which is exactly what we have been talking about today. For a world second largest economy like China, its opening can only be gradual. But with these capital market reforms, I believe the opening of China's capital markets has actually undergone a great change. If you look at the chart on the slide, you will realize that these measures taking place amid the inclusion of Chinese equity and bonds into major global indices. Well, figures on the capital flows suggested that global investors are very supportive of these reforms, with about 65 billion US dollars inflows in the first half of 2020 versus 62 billion US dollar during the same period last year. And about 3/4 of the inflows in that period went to bonds, with a focus on Chinese government bonds, of course, while the remaining quarter went into equities. That breakdown should remain the same for the remaining of the year, according to market estimates. And as an essential part of capital market, commodity always draw great attention by investors, institutions, and industrial clients. Here is just a chart illustrate that China has become the largest producer and largest consumer of iron ore and the largest consumer of many other commodities as well. In order to promote the development of the real economy and China's participation in the global distribution of resources and wealth, China's future market has opened up a non-international future contracts so far in past 3 years. From the listing of the first one was crude oil futures on INE in 2018 to the listing of crude oil options. Oh, what a consequence. Crude oil options on INE in June this year. We can see that this progress is very orderly and stable. Other than that, in our communication with the exchange, we were informed that in the future, chemical products and shipping index will also be open to overseas traders as international products. So me personally, I think this is a very positive signal, which not only means that in the future, foreign investors will have more investment targets as choices and industrial clients will have more ways to hedge, but also means that the pricing of Chinese future products will be more valuable. And now we have to talk about the above mentioned varieties. So you may still have questions. How can clients participate in the trading? Well, here is just a trading path diagram. Let's start with the very top on the page. If a foreign investor wants to trade A shares, he can directly open an account with HGH Security Company to trade securities and ETFs on the Shanghai Stock and Shenzhen Stock Exchange, as you can see right here. Oh, please also be aware that HGH Securities also provides clients with access to other securities exchanges like UK, Japan, and Singapore as well, just for our information. Okay, if the clients want to trade those 9, here's only 1, 2, 3, here's only 7 because we got 2 new, which are palm oil options and crude oil options. And these pictures definitely need to be updated. So if the clients want to trade those 9 international future products, we can discuss based on the situation. If the client has a domestic NRA account, then he can directly open an account with us. If he doesn't have, or if he is unwilling to use an NRA bank account, he can also open an account with HGNH International, because HGNH International is an overseas intermediary agency of our Nanhua futures. So clients can also trade those international future products in this way. And in addition to A shares and international future products, if clients want to trade more products, well, thanks to the new QFII regulation in November 2020, we can satisfy foreign investors' needs in trading other commodities and options listed on domestic future exchange, as well as the demand for, Peter just mentioned, public funds, private funds, and bonds, and so many else. Well, since Peter and Jamie had already mentioned this point before, I guess I will just briefly go through it in the next couple of slides. And the following slides is basically a summary of the trading path that I had just mentioned. A foreign investor can choose whether to trade with Nanhua futures or our overseas intermediaries according to his own situation. Well, speaking of which, we currently serve many overseas intermediaries. Among those, HGH is most closely related to Nanhua. In order to better meet the different needs of the clients, HGNH International has branches in different regions in the world, including Hong Kong, Chicago, and Singapore, and London. And of course, each branch has unique services. For example, HGH Hong Kong can provide clients with eSunny direct connection and has a professional service team to provide 24/7 customer service. And our UK company can provide credit granting for arbitrageurs. And our Singapore company can provide ATP, CQG, and TT as trading terminals. Well, most importantly, clients do not need to obtain an NRA bank account if they choose to trade through our overseas intermediaries, which greatly reduce the barriers to enter for those overseas investors. Okay, now you may still have questions. What if I want to trade other non-internationalized future products, commodities, options? Can it be achieved? Well, the answer to that is most definitely. QFII and RQFII has always been a hot topic, not only for overseas investors, but domestic as well. As you can see, CSRC and PBOC jointly issued a provisional measure on administration of domestic security investment of QFII in 2002, right after China joined WTO. Well, with almost now is 2021, so with almost 20 years of development, no matter the scope of QFII investment, entry barriers or overall scales have undergone very big changes. This picture right here shows how the QFII policy has been developed step by step from the initial total quota of, let's see, only 10 billion US dollars, and the investment scope is very narrow to now that the QFII quota is removed and the investment scope is very wide. The changes of QFII policy guaranteed that, well, China's capital markets definitely should and will be considered by investors worldwide. So I have mentioned, Peter just mentioned this part, so I'll just briefly go through it real quick. In this number 63 document released last year, in November, the entry threshold for QFII has lowered and the investment scope has been expanded. Well, this page is the scope of investment table under the new QFII regulation, which is basically everybody's concerns. Well, matter of fact, you don't have to remember all those letters. All you need to understand that is under this new regulation, commodities, options, and private fund has been added to the original investment scope. In other words, QFII investors now allowed to invest in securities, to bonds, to commodities, futures, options, public fund, and private fund listed on domestic exchange. And please be aware that all the private fund that I mentioned refers to securities investment fund, which is investment in the secondary market. In other words, let's put it this way, current QFII is not allowed to invest in private agri funds for the time being. And so based on what I've just mentioned, I believe everyone can basically judge whether the targets that you want to trade is within this range or not, right? So what parties could be potential QFII applicants? Let's look at this chart together. In fact, the range of applicants is broad, including fund management companies, commercial banks, futures brokers, security brokers, insurance companies, trust fund, pension fund, and all that. The above mentioned institutions and individuals can flexibly choose either to trade by themselves or invest in fund at the QFII level on the basis of obtaining, QFII qualifications. And those two blue boxes underneath just shows what you can possibly to trade or invest, which is basically all covered in the last slide. All right. So we have talked about what the policy is. So what is the transaction path in actual operation? Let's take a look at this image below, which basically shows what the investment structure would be look like. Well, in this case, I use HGNH Asset Management Company as an instance, since HGNH has got the QFII license since 2013 and is also one of our subsidiaries. So first of all, a client can set up a fund product in Cayman Island, right here, and then invest in our QFII account, or you call QFII account through Exchange Asset Management Company, which will allow the clients to trade domestic futures, securities, bonds, and private fund products at the QFII level. At the same time, products established by clients in Cayman Island can also directly participate in other exchanges around the world through our exchange subsidiaries. Well, the implementation of this structure is very flexible. The reason for that is if an investor wants to build a structured product, then the product can be set to ABC classes. If there is no such demand, it can be made into just a managed product. So, and also if the investor wants to do cross-market arbitrage, then he could keep the two parts of the domestic market and overseas market. If only invest in China, they only keep left one. So overall, this framework is the most essential part of QFII investment when it comes to products structure. Okay. And the following image may be more specific, which is the detailed structure of the Cayman Island product. You can design the products according to their need, like I just mentioned, which is very flexible. If you want to set up a managed product, then ABC class will be applied. If not, just ignore it. And if you want, if you want to trade overseas exchange, then keep the overseas part. If not, just ignore it. You see what I'm saying? This chart can be basically meet all sorts of transaction needs of different type of clients. Okay, moving on to the next slide. Let's see what has changed under the new QFII policy. Before the new QFII policy came out in 2020, both QFII and the QD has quota limitation, which led to the fact that many cross-market arbitrageurs traded from domestic China to overseas market, as well as in terms of trading paths. A bit more detail is the clients used to invest abroad through QD, even with high fees and limited QD quota. However, the new policy provides a better choice for such clients. Since QFII has now abolished the quota restriction, and even better, investors can directly invest or trade in the QFII level, the clients of internal and external arbitrage can set up an overseas fund and directly invest in the QFII account through the fund so as to trade the Chinese market. And the benefit is that the new model allows the fund to be registered offshore, for example, in case of the Cayman Island or BVI, providing much more regulatory flexibility. Okay, so why should clients choose Nanhua futures over other brokers? Me personally, I think it can be mainly reflected in global prices, technology advantage, and service we provide. First of all, like Peter mentioned earlier, Nanhua futures have branches in Chicago, Hong Kong, Singapore, and London to serve clients in different regions. And these branches are also qualified as trading member in major exchange around the world. For example, HGH Hong Kong is a member of Hong Kong Future Exchange. Our Singapore company is a trading settlement member of SGX and APEX. And our US company is a member of CME Group, DME Group, DME, and ICE US member. And last but not least, our UK company is one of the few secondary members of LME. So with that being said, clients can trade these major exchanges around the world all in one platform, right? If clients has a need for cross-market arbitrage, then our platform will definitely maximize the convenience of their trading experience. And the second I want to point out is our technological advantage. We have always said that ourselves and our future is not a brokerage company. Instead, we are a what do we call financial technology service company with derivative business as our core. Since our establishment, we have been, committed to the layout of the global trading network, especially in order to serve those high frequency traders. We have set up dedicated lines between major exchanges and provided computer rooms custodied to maximize their transaction speed. And besides, we're able to design cross-market product architecture for clients based on years of overseas business experience. And Nanhua is a very large platform. Our partners include various experts in the market, investment advisors, and custodian banks. So we are confident to provide that diversified investment scope, product types, and fund pass options based on clients' investment goals and risk preferences. And so far, our department have helped more than 10 QFII institutions successfully invest in the Chinese market. And I believe our experience in serving overseas institutions is one of the few in the market. Okay, I believe the above is the reason why clients should choose us. By the way, you can also search Nanhua Futures on LinkedIn or YouTube. We will regularly publish hot news of Chinese market and some research report from the Nanhua Research Institute. As you can see on the right-hand side right here is the contact information of our team. Please feel free to contact us by the email above if you have any consultation and or business cooperation request. If you have an inquiry about a certain business sector, you can also reach us through our personal email as well. And the host today is Mr. Zhang Yang, who is very knowledgeable of QFII and international future varieties. And I believe that would be pretty much everything I have for today. And I really appreciate your time and wish every one of you have a lovely weekend. All right, Alex, back to you.
All right, thanks, Xiaoyu, for sharing this. So as we come into an end of today's session, I believe most of us have gotten slightly clearer version of how QFII flows and what's the current situation of the upcoming policy. So in general, we have been working closely with our Hong Kong asset management firm and also custodian banks like Standard Chartered, who provides decent and professional custom services. So just to ensure that any of our investment clients, no matter you're from Singapore, from Dubai, India, or any other places in the world, will get the best services you deserve. Again, while we are all waiting on the right timing of the CSRC to gradually release with more details between QFII and the domestic commodity futures, it is always welcomed. And also, we should suggest to our overseas clients that you should start getting to know more about the Chinese futures market and how it works by opening up a futures trading account to trade such internationalized variety just introduced by Xiaoyu. Then you, who was used to trade via CME or other major commodity exchanges, should get a better idea of how the trading rules were set by our domestic commodity exchanges as well. For example, like iron ore and palm oil products from DCE. So that will be all from today's session. Again, we'll have 3 more upcoming sessions, still co-hosting with Darling Commodity Exchanges. We'll be having our US session and UK session and also our Hong Kong session. So we'll have you guys stay tuned and keep posted. Thank you very much for attending today. Thank you.